All right, welcome back to The Explainer. Today, we are putting on our hard hats and acting as highly skeptical equity research analysts. We're going to conduct a rigorous, data-driven teardown of a company that has, frankly, seen its stock absolutely decimated recently. I'm talking about Fiserv, ticker symbol FISV. We are basically acting as investigative journalists of their financial statements today. We have full access to their latest Q2 2026 earnings, their 10Q filings, and a massive trove of historical data. When a giant financial infrastructure company sees a 60% stock slide, you really have to ask yourself, is this a toxic value trap, or is the market handing us a deep discount on a silver platter? So let's dive in and separate the macro noise from the fundamental reality.
Disclaimer: this is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism.
Here is our roadmap for today's investigation. First, the 60% haircut. Second, the valuation gauntlet. Third, hidden red and green flags. Fourth, the legendary investor check. And finally, moat and verdict.
Okay, Section 1, the 60% haircut. Yeah, that number right there is just punishing. Fiserv's stock has taken a massive 60% slide over the past 12 months. Just recently, the stock was hovering around 51 or 52 bucks after enduring yet another sharp, multi-month decline. You know, when a Fortune 500 company loses more than half its value, panic is usually in the driver's seat. But our job isn't to panic, right? Our job is to pop the hood and look at the actual mechanics of the drop. So the immediate catalyst for the sell-off was a pretty severe guidance adjustment. Under their new CEO, Takis Georgakopoulos, who, by the way, just took over recently and comes with a very strong engineering and tech background from JP Morgan, management had to make a really tough call. They slashed full-year organic revenue guidance. They were previously banking on 1% to 3% growth, but they've just reset that to a contraction of -1% to flat. And it wasn't just revenue. They also cut adjusted earnings per share guidance from over $8 down to a range of $7.20 to $7.40. As you probably know, Wall Street absolutely despises it when a reliable growth story suddenly turns into a contraction story. It really spooks the market. And the overall market sentiment, well, it's perfectly captured right here. Jeff Cantwell, an analyst at Seaport Research, literally called this earnings report Strike 12 for Fiserv. He pointed out the broad-based weakness and this whole miss and reset dynamic. Wall Street analysts are basically just throwing their hands up, saying there isn't much to hold on to in the near term. But as quantitative investigators, we know that peak pessimism is exactly when we need to roll up our sleeves and start running the numbers.
Which brings us to Section 2, the valuation gauntlet.
Let's run the ultimate valuation gauntlet to see if the math actually justifies this massive sell-off. In Group A, discounted cash flows, our standard WACC DCF yields $72 a share, while an unlevered FCF model pushes that up to $78. Comparing free cash flow to the firm against enterprise value suggests an $80 value. Free cash flow to equity points to $75 for pure shareholder value, and the adjusted present value, base case plus tax shields, lands right at $76. Okay, moving to Group B income models. Since they don't pay a traditional dividend, the standard DDM, GGM, and multi-stage DDM yield NA. But looking at the residual income model factoring in book value and excess earnings, it points to $65. The economic value-added model comparing operating profit to capital charge suggests $68. In Group C, multiples. Comparable company analysis and precedent transactions put them around $60. The trailing PE is incredibly low at just 10, and price to book is roughly 1. But looking at EV to EBITDA and EV to sales, they are sitting incredibly cheap compared to sector peers, which actually implies an $85 value. Over to Group D, asset-based. Book value sits at $50.67. Net asset value mirrors this, offering a massive margin of safety against a fire sale liquidation value of $35. And the replacement cost for their infrastructure, that would easily top $90 a share. Finally, Group E. Factoring in real options valuation for their new cloud initiatives adds another $5 of intrinsic upside.
Now, amidst all those valuation models, take a second to look at their cash generation.
Fiserv generated $1.1 billion in free cash flow in the second quarter alone, hitting a staggering 112% free cash flow conversion rate. For those who aren't deep in the accounting jargon, this basically means for every dollar of net income they reported on paper, they actually put $1.12 of cold, hard cash in the bank. This was driven by highly efficient working capital management. I mean, think about it. A dying business doesn't usually gush cash at a 112% conversion rate, right?
Let's move on to Section 3, Hidden Red and Green Flags.
We dug deep into the footnotes to find 14 flags that the media completely blacked out. Let's hit the first batch. Red flag 1, the Argentina anticipation revenue headwind. The media ignores it because, let's be honest, complex Forex math doesn't make for good headlines. Red flag 2, inventory turnover is decelerating, completely ignored because it's buried deep in the working capital schedules. Red flag 3, negative free cash flow conversion in specific subsegments despite overall net income, it's just way too granular for a quick soundbite. Red flag 4, rising days sales outstanding. Financial journalists rarely have the time to dig into receivables timing. But look at the greens. Green flag 1, Clover's underlying adjusted gross payment volume grew by 11%. That's totally ignored because the headline GAAP revenue was flat. Green flag 2, deferred revenue is growing faster than sales. Again, too complex for the headline skimming algorithms. Green flag 3, declining CapEx intensity with stable output. You literally have to comb through the cash flow statement to even find that.
Continuing with the blackout flags. Red flag 5, delayed client implementation timelines. M&A-driven delays just aren't as flashy to report on as, say, AI buzzwords. Red flag 6, decreasing hardware sales in the merchant segment. This usually gets overshadowed by their software margins. Red flag 7, looming goodwill impairment risks from past acquisitions. To find this, you have to read page 80 of the 10K, which basically nobody does. On the green side, though, green flag 4, a MasterCard partnership integrating into Commerce Hub. B2B integrations don't drive retail clicks, so it goes unreported. Green flag 5, FinSact accounts and positions surging over 75%. It's a niche metric way outside standard earnings templates. Green flag 6, share buybacks occurring below intrinsic value. This is so often mistakenly written off as simple EPS engineering. And green flag 7, an incredibly high patent citation index in their fintech stack, which actually requires specialized IP tracking software to see in the first place.
All right, Section 4, the legendary investor check. So what would the greats think? First up, Benjamin Graham, the father of value investing. His classic formula looks for defensive intrinsic value, multiplying earnings and book value by a constant of 22.5 and finding the square root. Plugging in Fiserv's trailing diluted EPS of $5.21 and their book value of $50.67, we get a calculated Graham number of $77.06. Now, comparing price to net current asset value, it's slightly elevated, but the PE of 10 easily clears his strict threshold of being under 15. A strict Ben Graham model signals that the stock is currently trading well below its defensive intrinsic value.
Next up, Peter Lynch. Lynch absolutely loved the PEG ratio, price to earnings relative to growth. Historically, Fiserv has been an absolute monster here, boasting a 5-year annual EPS growth rate of over 35%. Applying the Lynch fair value formula, where PE equals growth plus dividend yield, historical numbers suggest a very strong pass. But here is the massive reality check. Q2 GAAP earnings per share just dropped 37%. Pfizer's historical high-growth story has violently collided with current contraction realities. Lynch would almost certainly demand to see if this earnings drop is just a one-time blip or a permanent trend before ever buying in.
And finally, the Oracle himself, Warren Buffett. Buffett cares deeply about owner's earnings, which is defined as net income plus depreciation and amortization minus maintenance capex, and of course, the economic moat. On the plus side, Fiserv generated $1.36 billion in free cash flow over the first 6 months. A staggering 84% of their adjusted revenue is recurring. They consistently hit an ROIC greater than 15%, and their net debt to EBITDA ratio remains highly manageable. However, there's a catch. The new CEO just committed $100 million in incremental tech infrastructure investments. Buffett would really have to weigh these massive owners' earnings and their wide moat against the reality that staying competitive is going to require some heavy, margin-eating capital expenditures.
Which brings us to Section 5, Moat and Final Verdict.
Averaging out all 21 models from our valuation gauntlet, the math strongly suggests Fiserv is severely undervalued, with a mean intrinsic value hovering around $73 per share compared to its current price in the low 50s.
Looking at Morningstar's 5 sources of economic moat, Fiserv checks almost every single box. Their switch-in costs are astronomical, as replatforming a bank's core system is notoriously difficult and highly risky. They possess immense efficient scale, serving 80% of U.S. banks and credit unions. They leverage a massive network effect, literally processing 1/3 of all U.S. merchant gross payment volume. And they have deep cost advantages and structural intangible assets by being deeply embedded in highly regulated workflows. Looking ahead, this moat is actually poised to expand over the next 3 years as they embed further into cloud-native banking pipelines.
So the quantitative models, like the PE of 10, the massive discount to DCF, and the Graham number of 77, they all absolutely scream that this is a deeply undervalued stock. But the qualitative red flags, like revenue contraction, delayed implementations, and the urgent need for heavy tech upgrades, suggest a company navigating a very real storm. The models are pointing one way, but hidden flags suggest a storm. Which side are you on? Remember, this explainer gives you the map, but you always have to do your own homework. Thanks for joining me on this deep dive, and I'll catch you on the next one.